Okay, so in this video, I'm going to explain the difference between the periodic and perpetual inventory system when recording your entries and so on, right? I'm also going to explain why on earth we have this cost of sales confusion, we have this FIFO, this weighted average. I'm going to create this whole business from the start and show you each transaction, how it differs differently, how we have this purchase account and this periodic, basically this whole system. Now, I created these simple examples so I can show you this whole system. You need to know this whole system. So once you know the whole system, you know how to do any transaction, whether hard or easy. So just for clarification, I never work with this thing. I just created this now. Reason being, I want to explain from literally knowing nothing. I don't even know how this is going to work. But from explaining, if I never do it, it's better so I can explain it better. Okay, so periodic and perpetual. Now, the processing system that we have been doing all this time is called Perpetual. This purple one, Perpetual. Perpetual is, it's simple, right? There's nothing wrong with it. We sell a good debit bank credit, sales, debit, cost of sales credit, inventory. It's simple, is what we usually do. But then somebody said, let's make periodic. Periodic, it stops. Now what I mean by stops, you might not know. Periodic inventory system, instead of saying inventory, they got purchases account. Instead of now working at cost of sales, they do it at the end of the year or the end of the period. So it confuses everyone here. But let me just show you, right? So in a month, right? So I'm just going to explain to you how this works. In a month of business, let's say January, a business, okay, let's not make January. Let's say the business starts in January, ends in December. So let's say January, he buys stock, all the stuff and whatnot, right? 31st January at the end of the month, the perpetual, you don't have to touch it. Why? It already got the cost of sales for the month. It already got all the closing balance at the end of the month. All these ledgers will have a closing balance. Done. Periodic, however, at the end of January, 31st January, you need all these ledgers to balance, not to balance, to close it off, to have a balance carried down for the next month. Problem is, in the periodic, we do not have a cost. Well, it doesn't record cost of sales. So the whole of January, the periodic won't have any figures in the cost of sales, unlike the perpetual. Perpetual, as soon as you do stock, sell stock, you're getting all these amounts automatically. This is a system machine automatically. Perpetual is all automatic, doing it for you. But the main difference between a periodic and a perpetual is periodic, any entry that has cost of sales, you leave it out. And second, when we buying stock or when we referring to stock, instead of saying inventory, we say purchases. Those two are the biggest differences. I might be thinking what I'm saying. Now, when I'm saying any journal entry that relates to cost of sales, leave it out. You might be like, hey, Yasin, what? Are you smoking something? Leave it out. That means cost of sales over here won't have a figure. That's right. It won't have the figure from 1st January to 30th January. That is why we stand at the end of 30th January and we do a stock count using our methods, weighted average or FIFO. And then we do 3 transactions. Just 3. Those 3 transactions we do will fill this cost of sales account with everything it needs, like the perpetual, and it'll make the purchase account 0. Done. This and this ledgers all will be the same as if you didn't do any, whether it's perpetual or periodic, it all look the same. Only 3 transactions to do it to record cost of sales. And we're going to be doing this, right? Now, so I told you, now when I said entry that has cost of sales, leave it out when doing periodic. For example, sales. To be honest, that's the only transaction. Sales, you record 2 sets of journal entries, right? Debit bank credit sales, that's 1 pair. Then, debit cost of sales, credit inventory. You leave that out because cost of sales and inventory is together in that pair. You leave those 2 pair out. The 1 pair, whatever pairs with cost of sales, you leave it out, that journal entry. Now, obviously, periodic will say purchases. So when we sell stuff, we'll say debit bank credit sales. That's fine. Debit bank credit sales. But then obviously when you say debit cost us, as soon as you see debit cost us, credit, you leave those 2 journal entries out because we will do 3 transactions at the end of the month to sort out our cost of sales that we never do all these months. Right, let's start. Now, just for clarification, more clarification here, right? There's two. Now, I'm showing you ledgers because I want you to get an understanding of the system. But sometime they want you to do journal entries. Now, like example, balance beginning of stock 1,000 rand. If you're doing a journal entry, you don't do a journal entry for balance brought down. You know what I'm saying? You'll do a journal entry for all this. I mean, let's do it, right? Okay, so I'm going to go slow with this because I want you to get the whole system. Let's say the question wants you to do journal entries, right? Journal entries for these three journal entries, right? Right, let's start with the periodic. Now, before I fill in the ledgers and do this whole system, I'm going to do the journal entries. For the first one, balance beginning of the stock. Whether using periodic and perpetual, you won't use it. You won't do a journal entry for it in a general journal. Why? You don't. You just don't. Right? Journal entries, you don't. For balance of the stock. You might be thinking why we need it. Well, we need it when we're doing periodic to work out the cost of sales at the end. That is why we need it. So let's go to the second transaction. Bought stock costing 500. And the reason why I got in the brackets there, that's how many products you bought, right? Bought stock costing 500. Very, very easy transaction. For the periodic, what will be? Debit bank, credit, sorry, bought stock. It'll be debit purchases, credit bank. That's it. Debit purchases, credit bank. For the perpetual, it'll be debit inventory, credit bank. Right, we're done. Third transaction. Sold stock for the selling price of 10,000 rand. Cost of sales is 1,000 rand. Very easy. Periodic. Sold stock selling price 10,000 rand. Debit bank credit sales. The amount is 10,000 rand. And then now see, going to the cost of sales transaction, you leave that out. But for the perpetual, we'll say debit bank credit sales 10,000. Debit cost of sales credit inventory 1,000. We'll actually put that there. So you see the journal entries. So I'm done with the journal entries now. Just for more clarification, if you have a return, they say return. For periodic, let's say you return 100 and worth of stock. For the periodic, it'll be debit. Let me think. Let's see. Debit bank sales. Wait. Return stock. Wait, when you bought stock, is debit purchase. Oh, it'll be debit bank credit purchases. So if you return stock, it'll affect the purchases account when doing the periodic, right? For the perpetual, it'll be debit bank credit inventory. See? Okay, so now let's start this whole system to show how it works, right? Okay, so now the system of here, I want you to look at it very, very carefully of how we're doing it, right? So let's change colors over here so you can see it better. Okay, so let's start, right? Balance at beginning of the stock 1,000 rand. So obviously it'll be balance brought down of stock 10,000 rand. 1,000 rand. Now you might be thinking why we have inventory over here. Inventory will still be under the periodic, just that at the end of the year we'll take out this amount in purchase and put it in the inventory. That is why we do our cost of sales calculation, but you will see just now. So balance brought down is 1,000 rand. So obviously on the debit side, 10,000 rand. Is it 10? No, sorry, 1,000 rand. And then obviously it will be the same, right? Now, if we in like February, and our year start January, this will be January's brought down at the end. After we do our cost of sale calculation, we update the inventory from the purchases. Okay, so bought stock costing 500. Bought stock, debit purchases, credit bank for periodic. So debit purchases. How much? 500, yeah. So debit purchases, credit bank 500. For the perpetual, it will be debit bank, bought stock, debit inventory. So 500, credit bank 500. Now obviously you can see the difference here. We're not putting in inventory, putting in purchases. Okay, and then cost of sales 1,000 rand. For the periodic, I told you any journal entry related to cost of sales, we don't do it. But for the perpetual, we do it. So debit bank credit sales, debit cost of sales, credit inventory. Debit cost of sales 1,000. Credit inventory. Debit cost of sales, credit inventory 1,000. Right. Now. If I tell you over here, both of these ledgers are exactly the same. Will you agree with me? Technically, right now they're not the same. But this is where in the questions you get in the exam, they say, work out the cost of sales for the year. And they'll tell you that for the periodic. Why? Our three transactions we do to work out the cost of sales for the periodic will ultimately make these ledgers of year the same as these ledgers of year. Now, let's just bring down the balances here. So this is at the end of the month. So the balance of the inventory account carried down will be, let's see, we got 1,500 over here and we got 1,000. So you put balance carry down 500. Yeah, it should be 500, and then the balance brought down 500. So we got a positive 500 inventory left at the end, right? For the cost of sales, I mean, you don't have to do anything. I mean, this is 1,000, that's 500. Right. Okay. Now you see, so see how our inventory in the periodic now is 1,000. It's not updated because the cost of sales inventory we're not updating when we're doing our periodic. But let me show you when. Now just get in your head, cost of sale calculation anytime you get it at the end of the month, obviously, to do this whole thing's ledgers. There's three transactions. Now behind these three transactions, they're not going to change. So there's three transactions, right? So let me do it in the bottom, yeah. Let me change color again so you can see in red, big red. Right. The first transaction you're gonna say it'll be debit cost of sales and credit. Now I might be thinking what we're gonna credit. We're gonna credit the balance inventory in the beginning. So inventory balance at the beginning. So I'm just gonna put inventory beginning, right? You know what I mean? And let's see what the amount is. So inventory balance at the beginning was 1,000 rand, right? So obviously 1,000. And then now the second transaction, it'll be debit cost of sales again. So you see debit cost of sales again, just remember. And now you might be thinking what we're going to credit. We're going to credit purchases. Now I want you to really think what we're doing here, right? Crediting purchases will literally make the purchases account zero, ignored. So debit cost, I say credit purchases. What's the amount? Credit purchases. So credit purchases, you basically need to work out how many rands you purchased over here. Bought stock costing 500. Is any other purchases? No. So 500. So 500. And our last transaction, instead of saying debit cost of sales, we're going to say credit cost of sales. But what you're going to debit, think carefully. It's going to be the inventory at the end of the year balance. Now this is where inventory at the end of the year balance, you need to use your FIFO weighted average. You see why we use weighted average and FIFO to do this journal entry. Debit inventory credit cost of sales, yeah. Now you are stopped here because you need to calculate your what's it called, inventory at the end of the year. Remember, this whole three transactions, you need to work at cost of sales. I mean, it'll produce a cost of sales figure. Right? But this, you want the closing figure of the stock. Closing figure of the stock. Now, easy closing figure of the stock. You can either use FIFO or weighted average. Let's do both. Okay. I mean, okay, we'll do. Must we do FIFO or weighted average? Yeah. Okay, over here. I should have did this better. Actually, no. Because now weighted average of FIFO is going to mess it up here. Okay, so let me just do it simply without weighted average of FIFO. Okay, so let's see. Okay, so this is part 2 of the video. So now we're working out now our closing stock figure, and this is where we need our weighted average of FIFO. Depends what the question tells you. So let's do FIFO, right? Weighted average. Because the reason why I'm doing weighted average is because weighted average will only work here because obviously when I set up this question, it wasn't supposed to be in line to work out FIFO, if you get what I mean. Like the question, I didn't get this question anyway, I made it up. So weighted average over here will work for this question, but FIFO won't because I never. But I'll show you how FIFO, if I do it, will like how it'll do. But let's do weighted average. So So now we want the debit inventory at the end. Now, our inventory at the end, you can calculate it, right? Now, when we're doing weighted average, it's very, very simple. Very simple, very simple. So, you bought, at the beginning, you had 1,000 rand worth of stock, right? Okay, so I'm just gonna, oh wait, no. Let me just go up. Okay, wait it. Let me, do it over here. Right. Weighted average, right? Weighted. Now, why is this thing not working, man? Come on. Weighted average. There's no way I just wrote average in symbol form. Anyway, you get the point, weighted average. So you bought balance. Okay, so balance of stock at the beginning is 1,000 rand, huh? 1,000 rand. How many products was there? 50 products, huh? Right. Bought stock costing 500. So you bought stock costing 500. How much? 10 products. Sold stock. Now be careful. We don't want the selling price. We want the cost of the goods. We all use the cost of the goods. So we're using only the cost of goods figure. 1,000 rand you sold, but it'll be in brackets, don't forget, because you sold it, so it's going out. The cost of the goods are going out. 30. Now, very easy. I want you to work out this amount, two amounts. 1,000 plus 500 is 1,500. 1,500 minus 1,000 is 500 rand. Hey, 500 rand. 50 plus 10 is 60. 60 minus 30 is 30. So you have 30 products, and this is where they'll show you in the question sometime. Like if you see last year's past paper, I think 2023, they show you the closing stock is a number. And then obviously you have to work out this amount, but this is how you work it out. So now you might be thinking, okay, we got this. What to do? They're saying over here 500 and that's 30. Now, this is obviously the answer. But normally what you'll do, weighted average, is you'll say 500, so you'll work out all this about 500. So 500 divided by 30, let's work it out. Oh no, that's how you do 500 divided by 30. So that means each product cost, now this is obviously going to be in decimals because I never make this question up. Each product costs 16 rand and 67 cents. Right? Now each product costs 16 rand and 67 cents. Right? We know for a fact we got 30 products, right? So times 30 will give you 500. It'll give you 500. Well, it'll be the exact same figure of here. If you write here 30, it is 500. That's the weighted average. There we go, 500 for 30 products. And you got 30 products in the closing stock. So now we know our amount of closing stock. Got 30 products at the end of the year. So from the beginning to the end, we got 30 products. From the beginning to the end, worth of products, we got 500 rand. So 500 rand worth of the 30 products at the end of the year. So now we got our amount 500. Now as we go down, just check out we got our closing balance to be at Perpetual. So you see somewhere along the line we're getting very, very close, right? So 500, right? So 500. Oh, why this thing's working? 500 debits, 500 credits. Right, now this is where it gets extremely interesting, very interesting. So get your popcorn. Get all your popcorn, everything, right? Okay. Now we're going to do these journal entries, right? Let's use the same color. Okay, right. So first now, all these three transactions, if they tell you the journal entry for the cost of sales, done, we done. This is the journal entries for cost of sales, we done, we'll get full marks, right? But I'm just showing you the process, how we'll end up at these ledgers for your information. Now, 1 second. Looking at this over here, why I never record sales over here? Debit bank credit sales, subs to have 10,000. I don't know why I never do that. Also, yeah, debit bank credit sales 10,000. Supposed to have that there. Yeah. Supposed to wait. Debit bank credit sales, debit cost of sales. Yeah, that's fine. I just never record sales. I forgot. Debit bank credit sales, you have to do it. Wait, debit bank credit sales. I'm just checking something here. Why I never debit bank here? Debit bank credit sales. Debit bank credit sales. Where I got 500 from? Oh, I bought stock, right? But when I sold stock, so it'd be debit bank credit sales 10,000. I think I forgot the transaction. Debit bank. Yeah, I think I forgot the transaction. So third transaction, debit bank credit sales is 10,000, debit bank credit sales 10,000, debit bank credit sales 10,000. Obviously, the second transaction, debit cost of sales credit inventory, debit cost of sales 1,000, credit inventory 1,000. But then you won't record it over here because this is periodic and that's dealing cost of sales. Okay, done. Now, okay, so let's do this transaction. Debit cost of sales 1,000 rand. Now all this is we working for the periodic because this perpetual is done. Periodic we're doing the cost of sales at the end of the month. So debit cost of sales 1,000. Now you see our account cost of sales here is nothing. That is why we do these three transaction cost of sales to put a figure in the cost of sales account. You see where it's going. So debit cost of sales 1,000. So debit cost of 1,000. So obviously on the debit side 10,000. 1,000. Credit inventory at the beginning 1,000. Or inventory 1,000. So you see how it's cancelling the beginning figure. Can you see what's happening? Debit cost of sales 500. 500. Credit purchases 500. You see what's happening. As soon as we set this, what happens? 500, 500. This purchases, account temporary, account closes, cease to exist. Because what's happening here is everything that's happening in the purchases are secretly going to the inventory and cost of sales via these three only transactions. See what's happening? And then the last one, debit inventory 500. So debit inventory 500. 500. Credit cost of sales 500. Credit cost of sales 500. Right. Now, let's see what's going to happen here. So let's work out the inventory balance over here. 1,500 if we calculated this 1,000. So balance carried down 5. Balance brought down 500. And guess what? You see how our inventory account balanced? I mean not balanced, well, 500 and 500, exact same thing. Look at that by doing the three transactions. Now let's look at the cost of sales. 1,000. Okay, cost of sales, something happened over here. Let's see. Because I know over here you're supposed to arrive at 1,000 rand, but here we're not arriving at 1,000. So there may be a mistake I made somewhere. We should arrive at the exact same cost of sales. So just bear with me. Forward if you want. I'm just gonna check if I did everything correct here. Debit cost of 1,000. Debit cost of sales 500. Credit cost of sales 500. 1,000. Let's see. You know, one thing about SkillSpark, taking Maths 130 has corrupted me. I'm busy looking at this here. I took this plus this minus this. And then in my head, I'm like, it's not going to be 1,000. So I literally paused the video just to see what entry I did, what error I made in this whole worksheet. Turns out, 1,000 plus 500 is 1,500 minus 500 is 1,000. It is 1,000. Maths 130 messed me up. Those people doing maths right now, oh no, accounting students won't be doing. That's good. Yo, maths messed me up. So it's right, what? It's exactly right. 1,500 is over here, 500. So obviously balance carried down by 1,000 rand here and brought down will be 1,000 rand here. So this will be the balance, 1,000 rand here. And check here. I want you to check what we just happened in this whole process, right? This is interesting, very interesting. Let me get a nice color out. Yeah, the big color. Wait, let me make this thicker. Right. Now, you got a 10,000 rand balance in the sales. In the periodic, you got a 10,000 balance in the perpetual. You got a 500 rand balance at the end of the inventory. You got a 500 balance in the perpetual. You got a 1,000 rand balance at the big end of the periodic. You got a 1,000 rand end at the balance of the cost of sales in the perpetual. You have a bank of the balance. Also brought down over here 10,000. This is 500. 9,500. So 9,500 is also bring down over here 9,500 and this 9,500. Yeah, same thing. So you have end of the bank balance, end of the bank balance. This all match as if you never did any of the periodic versus perpetual. So can you see we did this whole system just to show that this purchases cancels out, that this cost of sales gets recorded via doing these three transactions. these three transactions. Doing these three transactions will do everything for you in these transaction ledgers above. You see, so this is why businesses do this. Business do this every month at the end of the month. That is why now at the beginning of the next month, now let's say April, now this will be my opening balance for the inventory 500 in my inventory account. But during that month, we do purchases, but the purchases close at the end, fills it to inventory. Inventory gets updated monthly, every month, right? That's how we do it. Now, I was talking about weighted average. We did weighted average over here, but let's say if they did FIFO. So obviously, we won't have our closing balance of the inventory, so that work it out. We know we'll have 30 products at the end, right? Because 50 products plus 10, that's 60, minus 30, that's 30 products. So we need to know via FIFO what this 30 products cost. So very easy. I want you to look at where so we bought stock here. Balance at the beginning is 50. We bought stock here 10,000. 10. We're going to sell stock here 30. So this 30 over here will come out from the 50. So you're only left with 20 stock over here, and then 10, that's fine. But what I'm trying to say is that 30, first in, first out. So this 30 will come from this 50 over here, because first in, first out. So now, you got 20 over there. You want to work out how many products 30 cost. So 30 closing balance products you got. You want to work out what's the end figure. So obviously there's only 20 here, that's fine. We'll say 20 times, what was the cost? What was the cost here? 1,000 divided by 50. That's 20, isn't it? 20. Now we need to get the other 10. Where do you get 20 products? We need 10 to make it 30, so 10 times. Obviously, first in, first out, you start at top, so 10 will be here. So this will be 59. And then whatever figure you get, that'll be my FIFO method for calculating the closing balance. You see what I'm saying? So we're using the FIFO and weighted average to get the closing figure over here, right? So now can you see how this whole system of operation operated? This whole system of molecularity, this whole system of elasticity, how this whole system works. And that skill spark, that's just how it goes, I guess. That's just how it goes. Yeah.